Good morning. As we head into the weekend, the markets are now closed. Bitfarms, ticker BITF, finished its session on Friday, November 7th, 2025 at a price of $3.66 per share. It was a volatile day with the stock hitting a low of $3.29 and a high of $3.67. Ultimately closing down about 0.81% from the previous session. Now, the common expectation for a stock like Bitfarms is incredibly simple. It's a proxy for Bitcoin. The belief is that if the price of Bitcoin goes up, Bitfarms stock goes up, but with leverage. It's the narrative that gets traders on the Robinhood app or using SoFi Invest to buy in thinking they're getting a turbocharged version of a Bitcoin investment. The reality, however, is that this narrative is fundamentally broken and misses the entire high-stakes drama happening inside this company. That 0.81% drop wasn't just Bitcoin waffling. It's the market holding its breath because the simple mining story is dead. The real story is about a company in the middle of a desperate, expensive, and fascinating pivot away from mining and into artificial intelligence, and the institutions are starting to get nervous. The common ground we all stand on is that Bitfarms has historically been a Bitcoin miner. They plug in computers, use electricity, and produce Bitcoin. This is what attracted the initial wave of investors, the ones who saw it as a pure play on the digital assets rise, a high-growth name to sit in their individual brokerage account right next to their Tesla stock or Nvidia stock. But let's challenge that idea immediately. If you are holding Bitfarms today thinking it's just a miner, you are investing in the past. The reality is that this business model, for them, was showing signs of breaking. We have to look at the numbers. Earlier this year, in their Q1 2025 report, the company's total cash cost to produce a single Bitcoin had ballooned to $72,300. Think about that. With Bitcoin's price being so volatile, that is a terrifyingly thin or even negative profit margin. The Bitcoin halving event wasn't a party, it was a margin-crushing event that has forced the company's hand. So this recent stock movement, that volatile day on Friday, isn't about Bitcoin's price. It's about anxiety and anticipation. The big event on the horizon is the company's third quarter 2025 earnings report, which is scheduled for this coming week on November 13th. The expectation for those who haven't been paying attention might be for a decent quarter, given Bitcoin's relative strength. The reality is that analysts have been quietly and aggressively slashing their estimates. The consensus estimate for the quarter is for a loss of 0.02 cents per share. More telling is the fact that this estimate was revised downward by 50% over the last month. And the most accurate estimate, which tracks the most recent analyst revisions, is even lower. This suggests the professionals using sophisticated interactive brokers trading platforms, the ones who read every filing, are expecting bad news from the legacy mining business. They're remembering that last quarter, Q2, Bitfarms also posted a surprise loss. The market is bracing for a second miss. This is where the entire story shifts, because the company's management is not blind to this. They know the pure mining game is getting too competitive and too expensive. So, they have initiated a massive, company-altering pivot. Bitfarms is attempting to transform itself from a Bitcoin miner into a high-performance computing and AI data center provider. This is the new narrative, the one that has analysts at firms like H.C. Wainwright and B. Riley raising their price targets as high as $7, not based on the struggling mining business, but on the potential of this new AI venture. This is the central tension of the stock. You have a legacy business that is financially deteriorating and a new conceptual business that is exciting but unproven and, most importantly, incredibly expensive. How are they funding this? This is where the risk becomes clear. They recently announced a massive $500 million convertible senior notes offering. They also secured a $300 million project financing facility from Macquarie Group, a major institutional player. This is a huge injection of capital, but it's not free. It's debt and potential dilution. They're using this capital to fundamentally change their footprint. They recently sold their Yguazú facility in Paraguay, a strategic retreat, and simultaneously acquired Stronghold Digital Mining. This isn't a random shuffle. It's a deliberate rebalancing to the United States to gain access to what they hope is lower cost, more stable power to build out these new AI and HPC data centers. They are, in effect, trying to become a different company. They are trying to become an infrastructure play, something that Fidelity's large institutional funds might find more palatable than a volatile miner. This creates a fascinating and dangerous dynamic for anyone doing their own self-investing. On one hand, you have a story that sounds amazing. You're moving away from the volatile world of Bitcoin mining and into the hottest sector on the planet, AI infrastructure. This is what's giving the stock its high valuation, and it's what has analysts excited. The expectation is that they can successfully build this new business. The reality is that they are now competing with a different set of giants, the data center REITs, the cloud providers, and they're doing it while carrying a legacy business and a new pile of debt. This isn't a simple online investment anymore. It's a bet on execution. The institutional sentiment, which is often a smarter indicator than retail chatter, reflects this confusion and nervousness. Recent filings show that institutional ownership actually decreased by over 12% in the last quarter. We're seeing major funds, the kind that Fidelity Wealth Management might use, trimming their positions. Vanguard reduced its holdings. Renaissance Technologies reduced its holdings. Citadel, a major market maker, reduced its call options. This tells you that the smart capital is getting skittish. They are not as sold on the AI pivot as the analyst price targets would suggest. They see the risk. They see the $72,300 cost to mine a Bitcoin and the $500 million in new notes. And they are choosing to take some chips off the table ahead of the November 13th earnings. So, let's talk about what this means for you. If you're a long-term holder, you're not in the same investment you started with. You're no longer holding a simple Bitcoin proxy. You're a venture capital investor in a capital-intensive infrastructure project. This kind of complexity is why some investors just opt for Schwab Intelligent Portfolios to avoid having to parse the debt covenants of a Canadian mining company pivoting to AI in Pennsylvania. It's not a simple hold like Apple stock, which is driven by predictable iPhone sales. This is a high-wire act. I'm curious what everyone watching thinks. Comment below if you think Bitfarms' pivot to AI is a smart move, or if they should stick to just mining Bitcoin. Do you believe in this transformation, or do you think it's a desperate, high-risk gamble? Looking forward, we have two very clear divergent paths. The expectation scenario, the one the $7 price targets are built on, is that the November 13th earnings are kitchen sinked. Management comes out, confirms the mining business is tough, but then dazzles the market with concrete plans, contracts, and timelines for the new AI and HPC business. They show that the $300 million from Macquarie is being deployed effectively, and they guide for a future where high-margin, stable AI revenue replaces the volatile mining revenue. In this scenario, the stock absorbs the bad news and rips higher as the market reprices it as an AI infrastructure company, not a miner. Then there is the reality scenario. This is the one that the institutional selling and the plunging earnings estimates are warning about. In this scenario, the November 13th report is just bad. The mining losses are worse than expected, the costs are still out of control, and the update on the AI pivot is vague, filled with plans but no contracts. The market starts to see the $500 million in notes not as growth capital, but as a lifeline to plug the holes in the sinking mining ship. In this world, the $7 price targets look ridiculous, and the stock could retest its lows, as investors realize the company is caught between two worlds, mastering neither. So, as we wrap this up, that $3.66 closing price is the market's perfect indecision. The 0.81% drop on Friday is just noise. The real story isn't the daily wiggles.